Credit cards are big business in the United States, and with the merger of Capital One and Discover, they're going to get even bigger. The all-share merger announced on Monday night between Capital One and Discover will create a new number one in US credit cards with around $250 billion of loans in a market of well over $1 trillion. Discover's also a little unusual because unlike other credit card issuers, it has its own payment system, a little like Visa and MasterCard. Card issuers have to pay networks whenever customers swipe, and by owning its own network, Capital One would save money and boost its profits. So the deal from that perspective looks pretty logical. There are, though, a few obstacles that Capital One and Discover will have to surmount first. One is that the current White House is waging war against what it calls junk fees, which include the penalties that credit card firms charge, and that's a threat to future profitability. The banking regulators, in this case the Federal Reserve and the Office of the Comptroller of the Currency, are also a little sceptical of mergers that create new megabanks. That doesn't mean that they won't approve this one, but it does mean that the timing of that and any conditions that might attach to it are hard to predict. There's an extra bit of grit in the wheel here because Discover has its own issues. Poor compliance and overcharging of some merchants last year contributed to the CEO quitting, and the new CEO has only just started. The risk is that the deeper a new owner scrubs, the more dirt they might find. All that might be why the market has so far been fairly lukewarm on this deal. Discover shares were up on Tuesday, but not by as much as the terms of the merger would suggest, and Capital One's shares barely moved. Investors are presumably factoring in the non-zero probability that this deal doesn't even go ahead at all. But given the perks of running America's biggest plastic purveyor, you can see why the two companies want to give it a whirl.